In July of 2022, the U.S. Treasury yield curve, that's measured by the 2-year versus 10-year, began a pretty decisive inversion that brought it to an over 40-year low of negative 84 basis points. That was on December 5th. Now, over the subsequent 3 weeks, that spread moved back up to negative 47 before its more recent collapse to a current level of negative 67. Now, historically, the inversion of the yield curve is a pretty accurate predictor of a coming recession. And although the depth of the inversion doesn't correlate well to the depth of the recession, it does tend to increase the reliability of the recession prediction. Over the last 10 months, the 5-year inflation prediction, according to break-even rates, has collapsed from 3.59 in March, right when the Fed began tightening, to a current level of 2.20. The Fed funds futures curve is currently saying the probabilities favor another 50 basis points of tightening at the next 2 meetings, but that the Fed will pivot to eases by the end of 2023. This according to the CME FedWatch tool. The question traders will now ask is, will the Fed continue aggressively beyond the point where inflation remains a threat and force a need to ease in the months ahead in response to a potential recession? If a trader believes that the curve's inversion could begin to return to a normal slope, they could express that by selling the January micro 2-year Treasury yield futures contract at 4.16 and buying the January micro 10-year Treasury yield futures contract at 3.53. Now, this represents buying that spread at negative 63. A target for this trade could be placed at the September highs of negative 15, and a stop could be placed below at new lows of negative 90. This trade could make $480 if the target is reached and risks $270 if you're stopped out of your level. Now, if a trader believes that the curve could invert further from here, they could express that by buying that January micro 2-year Treasury yield futures contract at 4.16 and selling the micro January 10-year Treasury yield futures contract at 3.53. Now, that would be selling this spread at negative 63. A target for this trade could be placed at the psychological level of negative 100, and a stop could be placed above at negative 40. This trade could make $370 if the target is reached and risks $230 if you're stopped out of your level.